When you own real estate and or want to own real estate, you want to think about sometime down the road, either for you or your family. So when you capitalize your future gains, there are many strategies like 1031 or putting it into a trust. Now today's guest is Ruth Benjamin, who has been a tax strategist for decades. And she'll not only give us a strategy, but she'll give us a mind rate of strategies, and some of which will be a combination of different type of strategies. Let's get into the podcast with her. Ruth, thanks for joining us.
Thank you, Charlie. And I'm here to tell you about how many different ways you can defer your tax bill without necessarily doing a 1031 exchange. I have been in the 1031 business for over 30 years. I'm Ruth Benjamin. I live in California. I am a capital gains tax strategist. So I use many different solutions to help people defer and in some cases eliminate their capital gains taxes depending on their goals. So we're going to be talking about a few of them today. So they're going to be quick. That would probably overwhelm you a little bit, but the goal to this podcast today is to get you to make a phone call and let us walk through your situation. So one of the strategies that is very popular is called tax deferred cash out. So if you have a lot of your profit going to taxes for capital gains, this is something you should pay attention to. Or you don't want to reinvest in real estate. You're just tired of the tenants and the toilets. And you want to avoid depreciation recapture tax. First of all, if you have not been depreciating your rental real estate, the IRS could still tax you on the depreciation recapture. So if you're not doing that, make sure that you start doing that. Okay. So this avoids depreciation recapture tax. It avoids cancellation of debt, which means if you lose a home, a foreclosure or a short sale, the lender issues a 1099-C and we can avoid that tax bill. Okay. So this defers the capital gains tax for 30 years and you get your cash within 5 days of closing on the sale of your real estate. And it can rescue a failing exchange if you use the right accommodator that cooperates. The cost of this strategy is 6.7% of the net sales proceeds before any mortgages are paid off, and you must use the money for business or investment purposes. So this particular strategy can be used for real estate, businesses, privately held stock, cryptocurrency, art, antiques, aircraft, watercraft, and mineral rights. So a good person for this strategy is an investor, a business owner, a person who owns a primary residence. This is not the best strategy, but we do have other strategies to accommodate that. So here it is real quick. If you have an asset to sell, like I said, let's just say real estate in this example. So you sell this asset to a capital asset dealer. You sell it on an installment contract, interest only for 30 years. So the capital asset dealer doesn't want you to wait 30 years to get your money. So they introduce you to a lender. The lender is going to loan you 95% of that installment contract value. Okay. The capital asset dealer, once they buy the property from you, they sell it to the buyer and the buyer's out of the picture. So then they introduce you to the lender that will give you 95% of the value of that installment contract. So now you have cash. Okay, cash that can be used for business or investment purposes. And 30 years from now, you're going to have the same tax bill that you would have had today, but now you have 30 years to make an investment to pay that tax bill. All right. The second method I want to talk about today is called the doing well while doing good preservation system. And what this is if you're worried about getting sued, in a lawsuit. Are you concerned about protecting your legacy for your children and your grandchildren? Do you think you're immune from lawsuits because you have a corporation or an LLC? Did you know that the veil is pierced on LLCs and corporations 46% of the time? So unless you have 35 or more members in your current LLC, you don't have the protection that you think that you have. So we have the solution that gives you the best asset protection available in the United States without going offshore. And it also provides powerful tax mitigation benefits. So this is something for everybody. We had a client back in the 90s that he was sued by the state of Maryland, and the Maryland sued him 3 times over the period of 8 years. And because he had his trust in place, they were not able to get any money from his estate. So this trust is a contract between the grantor and the trustee. That contract says if you're not a beneficiary of this trust, you will not receive any money from it. So that means even if you get sued or your trust gets sued and they win, they can't collect because they're not a beneficiary of your trust. So it's a very powerful tool. I suggest people that own multiple properties or even just their primary residence protect themselves so nobody can take it from you. A lot of people are sue happy, right? They want you to take care of them for the rest of their life for many different reasons. Right. So protect yourself. Don't let yourself get caught in that. This trust helps you to bankruptcy proof your personal assets. If you're in the process of getting married and you have real estate and you maybe don't want to ask for a prenup, this is better than a prenup, because if your spouse leaves, the trust still owns the house, you don't, so they cannot touch it. So this non-grantor complex trust is the only entity that gets unlimited contributions and 100% deductibility and an additional year to make that deduction. So what that means, if you're a charitable giver, when you give money to your church or St. Jude or Wounded Warriors, you can write off up to 60% of your adjusted gross income. There's limits to what you can deduct. Using this trust, no limits, and so unlimited deductions, and you actually have an additional year to actually make that donation so you can write it off on your tax return. So nice. There is no trust that can eliminate the taxes just by owning the trust. Ours, we're not claiming that. It uses IRS Code Section 642. You need to have a private family foundation to get tax mitigation.
So what's the difference between delaying the tax and just paying it out, from the get-go?
Well, if you don't want to pay out the tax right away, but when you make the charitable donation, the non-grantor trust allows you to make it a year later. So if you have a $100,000 of adjusted gross income on your tax return and you don't want to pay any tax, you could put the $100,000 in your private family foundation that's created for you, and you can pay 0 on your income tax. Okay.
Oh, wow.
So there's different ways to go with that. So yes, you can legally zero out your tax bill. We never actually, tell anybody to actually do that because you need your taxes to show you have income to buy things. So it depends on where you're at in your life. So this strategy is a strategy that can help with your capital gains tax. And I'm going to walk you through that now.
Cool.
So if you have a piece of property that, you're going to sell all your properties to the trust and you're going to sell it. You're not going to donate it to your trust. It needs to be a sale so it keeps the non-grantor status. So you're actually going to sell your property to your trust today at fair market value on an installment contract, interest only. So then the trust has to own it for 2 years and a day. After that 2 year and a day passes, your trust can now sell that property to a buyer. So let's say when you sold it to your trust, you sold it for $1 million. Now, right. The trust 2 years later sells it for $1,100,000. So the trust now only has a gain of $100,000. Okay, it bought it for $1 million. It's going to sell it for 1.1 because it has its own tax ID number. It files its own taxes. So now, if it sells for $1,100,000 2 years from now, you have a choice. If you don't want to pay taxes or the trust doesn't want to pay taxes on the $100,000, that trust can put the $100,000 into its own private family foundation that you own, and you are not going to pay any tax. You deferred the 30-year installment sale and you eliminated the $100,000 gain by using the private family foundations. Private family foundations are no joke. You have to give 5% of the foundation's asset to a true charity every year. And if you don't want to give it away to a charity, you can put on a charitable event. So my business partner has an autistic grandson. He puts on an event for 25 autistic children every year and horses. He invites the family, he feeds everybody and gives them a t-shirt. That all goes to that 5%.
Wow.
So then if you put the 100,000 in, 5% is 5,000. You have $95,000 sitting in your foundation checking account. That foundation money cannot be used for you or your family, not your children, spouse, not your parents, your grandparents. But if you have a brother or sister that you might want to help out, you can grant them money or you can loan them money out of your foundation. And if you're an investor, the foundation works for any type of passive investments. So if you're going to buy a piece of property and you need 30% down payment, you could pull that cash, have your foundation put the cash in and own 30% of that property, and you own the other 70%. So that way, cool. 30% of the rents will go to the foundation and the 70% will go to you. And if that property is ever sold, 30% goes to the foundation. So this is way that you could be buying investment properties from money that you normally would have given to the IRS. Okay, so you can build your wealth with this strategy. This is good for people that own just one home, multiple homes. I have people that don't have a home yet, but they're setting up their trust. So when they buy their home, they're ready to go. So the next strategy I want to talk about is called Charitable Holding Company, which again has the stress of capital gains taxes. So when you use the Charitable Holding Company, you do get an upfront charitable donation using this strategy, 30% for real estate and up to 60% for cash of your adjusted gross income. That's the limits the IRS puts on you. 30% for real estate, 60% for cash donations. And that 60% is of your adjusted gross income. So again, like I said, we can create calls and figure out your exact situation. But the beautiful thing about this strategy, you make a donation to this LLC and you have full access to the cash. So this eliminates up to 99% of your tax bill. It's elimination, not deferral. This one does use life insurance to give donations to charities, and you can give this charitable holding company to your children or your grandchildren. And this works for everybody, business owners, investors. But the key is you have to get this strategy set up before you enter into contract with your buyer for any type of business. So let's walk through this one. Let's say you have $1 million home. You're going to donate that home to a LLC. It starts out as a single member LLC. You own it. You go down and open up a bank account with the bank, and we're going to donate that property to this LLC. Now, when the property sells, all the cash is going to go into that LLC checking account that you just opened. So you have full control of the money. So we don't want you to grow the asset in this LLC because the attorneys are going to create an operating agreement that says you own 1% of this LLC and a charity owns 99%. You get to pick the charity, whoever you want it to be. The charity is going to sign a gift letter acknowledging that they're going to get a gift maybe 40 years from now. And they're acknowledging that they're going to be responsible for 99% of the tax bill. So the cash is sitting here in the LLC. We don't want you to grow it there because if you have growth in that account, 99% of the growth has to go to the charity. So there's a trust created. In this situation, it's called a BDIT trust, BDIT, Beneficiary Defective Inheritors Trust. It lasts for 365 years. You are the beneficiary and the trustee of this trust. So we want the LLC to loan your trust all of the cash, and the trust is going to give a note back to the LLC with a reasonable amount of interest. So you check the applicable federal rate, and right now it's about 4.37%. So that is created. Now, where the security comes in and where the charity is going to make sure they get their donation is we have a secured growth wealth strategy. It involves life insurance. So the person that owns this property can be insured, or their spouse, their children or grandchildren. Anybody who would benefit from their estate could be the person that gets the life insurance. So the trust is the one who owns the life insurance. They get the death benefit. So once that person passes away, the death benefit goes to the trust. The trust then pays off their note. Then the charity gives their note. The LLC gives their note to the charity, and it's all done. This means you're selling a piece of property for $1 million. You are only going to be taxed on $10,000. That's why this strategy is so powerful. Then the last one I'm going to talk to you about is called the Liquid 1031. That one is you use a standard 1031 exchange rules. You have to buy a property equal or greater to what you sold. Got to roll all the equity over to it, and you need to get a loan at the time of closing. What that loan balance was, you need to get a loan equal or greater to what you sold. Then you have 45 days to identify the replacement property, 180 days to close. You can use this strategy as a backup to your 1031, or you can use it right away, straight to the strategy Liquid 1031. So you close your property using the 1031 standard policy, and you identify a TIC product. This TIC owns acres of land in Utah. So you identify that you want to buy that TIC product. Then you purchase it, you close, everything's done. You actually get a deed and you get a title policy for the land in Utah. So 2 weeks after you own that land, you can refinance your interest in that land and pull out 93% of your cash. That way, the loan comes to you with no payments for 30 years. It resembles a reverse mortgage. So you have full control of your funds to invest this money in any way that you want. 30 years from now, the TIC company is going to come to you and say, hey, do you like what we built on this? Because it's going to have residential, commercial, and a gas station. So you can keep your interest by paying them back the loan with the interest. Or you can simply say, no, I'm going to deed you back my land, and that extinguishes the loan. So if that happens, then you would be responsible to pay your taxes at that point. But if you pass away in the 30 years, your family gets step up in basis and the tax bill goes away. All they have to do is simply deed the land back to the TIC company, and they don't have to pay back the loan, and they don't have a tax bill. So the family would be completely excited to receive that step up in basis, and the tax bill has been eliminated. So the main thing is, the first rule of planning is don't lose your assets. And that's what we're here for, to help you not lose those assets and give you many different ways of deferring or eliminating that tax bill.
All this while, I always thought that rich people have this enormous, grateful heart that they want to give all their money away, and they have all this charitable trust that they set up, but it's like, so they're not really doing it for other people.
For those donations.
They're giving it a little bit away, but keeping for a good reason, so they can keep a lot more for themselves. It's not because they want to give. Oh wow, okay. So which is a good strategy for each individual? Do they is it going to be a mixture, or is it going to, depending on what their portfolio is? Assuming they own 2 family residences in Silicon Valley, is that good enough to want to set up a trust like that?
Oh, yes. Even if you have just one home, it's what you want. You want to protect it. It's something that you own, and the last thing you need is for someone to walk across your lawn, trip and fall, and decide that, you need to take care of them. Or maybe you rear end somebody. You bumped them at a light when you picked up your phone, right? And now they decided that they want you to take care of them because you have all this money. They don't want to work anymore. They want you to take care of them. So it is very important that everybody protects themselves with the asset protection. That's the most important thing.
Is there a minimum that you should look at that setting up a structure like this makes sense?
Well, like I said, anybody that owns a primary residence, it absolutely makes sense.
But what if the primary residence is only like 300,000? Does it make sense to do it?
Yeah,
Then?
absolutely. You don't want to lose what you own. So it makes sense for everybody. And we do have different levels of trust that give the asset protection. So we definitely want to talk to everybody. I think everyone should have that protection, especially in this day and time. There just seems to be a lot going on in the world, and you just need to be able to protect what you have.
On a yearly basis, will it cost more to maintain such a structure? What are the cost implications?
There's no additional cost after the trusts are set up. The only cost is that you have to file a tax return on it. It's its own entity. So anywhere from $500 to $1,500, depending on your CPA. I have been in the 1031 for many years, and yes, we do have a company we work with for I call it simple 1031, which it's not simple when you're not working with it every day. But the main thing here is it's not one product fits all. And we might tell you, if you have a large sale going on, we might tell you, well, let's take this percent and do a 1031. Let's take this percent and do a charitable holdings. Well, let's put this into the trust. It all depends on what you have, what your goals are for the money. And we structure, with our attorneys, we structure the best solution for you and to lower that tax bill and to give you that protection.
So guys, if you guys are interested to find out a little bit more about how all these tax strategies work, Ruth's information will be in the link below, all her contact information, her email. And if you want to reach out to her, or if you want to reach out to her through me, just ping me and I'll give you her details. So this is really, really, really good stuff. It's a little bit, it's not easy to put something like that together, but you need somebody who understands this thoroughly and is able to not only come in to make sense of this entire tax thing, but also to make sure this thing works. And I think you mentioned this strategy has worked for 30 years at least.
Yeah. They all been in place for a really long time.
Cool. Ruth, thank you so much. Any parting words, anything you'd like to leave us before we call it a day?
I would just say to you, before you decide to pay that tax bill, have a conversation and see if there's a solution that you're comfortable with. Your we love talking to your tax advisors, CPAs and attorneys. Those are the people we love talking to help them understand how these things work so they can help all of their clients.
Cool. Great. Thank you so much. Again, thanks for coming on the show and really appreciate the information. Again, information and contact information will be in the description below. Thanks, guys.